let's address another set of earnings. And we have Rahul Guha, the MD and CEO at Thyrocare, joining in on the show right now. Rahul, hi, morning. Good to have you on the show. It's been a good set for you on the Q4. Tell me, what's been the overall growth in terms of volumes that you've seen, and how much of this was on the back of price led, and how is it that you see the competitive intensity in the industry at the current levels?
Thank you for having me. And overall, look, the competitive intensity, as I've been saying for the last couple of quarters, seems to have come down. And this quarter, it's reflected in the numbers as well. But definitely, when you're in the market, you're seeing a lot less price competition, much more competition on quality, NABL accreditation, turnaround times. Less price cutting that we're seeing in the market, and that kind of reflects in our numbers as well. We also implemented a few things to ensure that we keep the focus on the right kind of growth. We implemented a tiered pricing structure so that our large franchisees would actually get the benefit of price, but our smaller franchisees, we didn't bring down the price that much. So it's been a good, healthy mix. Our core business grew 18% year on year this quarter. I'm very happy with that, much ahead of where we thought we would land. Overall, for the year, also, our core business grew at 16%. And if you look at the pre-COVID period to the COVID period, we are now on an accelerating growth trajectory. So I'm very happy with the base that we've built. And given the market intensity going forward, I'm very hopeful for the future.
We've been speaking to a lot of other diagnostic companies, some of your peers. All of them are very confident that the double-digit growth is back and competition is not going to intensify. So can we assume that at least for the large 3, 4, 5 organized player, now double-digit growth, pricing power and less competition could be on the anvil?
I think that's true. I don't think competition will fully go away. And, these are all somewhat linked to cycles, and when cheap money comes in, definitely people look at how to burn and grow. But I would say there's a lot of rationality now in pricing. Many of the new entrants who had come in effectively with a low price, deep discounting model have pulled back substantially. Everyone. And so therefore, I feel the overall competitive intensity has come down. I would also like to clarify a large part of the competitive intensity came in largely metro tier 1. If you look at many of the new entrants, their footprint is 10, 15 cities max. Actually, the opportunity for diagnostics sits in tier 2, tier 3. And now you see most of the leading players actually focused on that. Thyrocare has always been tier 2, tier 3 dominant. And so therefore, we continue to expand deeper and deeper into India as outlined in our strategy.
Fair enough. And let's also talk a little bit then when it comes to the entire margin profile of the company as well, because that as well seems to have improved significantly. What exactly has led to this, and where importantly do you see your margins headed in FY25?
The margins actually to a large part is because of the ESOP charges. Our normalized margin outside of the ESOPs has more or less stayed stable. And we've always been guiding that we will keep that stable. As we get into next year, we expect operating leverage to come in. But you have to remember, we are also investing in Tanzania. We are investing in building ECG at home capabilities, which are very new service offerings for us. So whatever operating leverage comes next year, we'll reinvest into the business in building out these new lines of business. So I think you should expect our normalized EBITDA to kind of stay stable. Of course, as the ESOP charges continue to come down over next year, the reported EBITDA will get better. But that has nothing to do with management's performance. That is just accounting.
That's really what the margin can be attributed to. Fair enough. But if we were to just talk a little bit more about your numbers, it includes the financials of Pulse High Tech and Think Health that was acquired in Feb. Can you share the contribution to the overall revenue pie and what kind of growth they're witnessing?
They're both very negligible at this point, so I wouldn't take too much time. I mean, both of them together will account for less than I think about 2% of our revenue. So I wouldn't, spend too much time on those. They're very nascent businesses that we are building.
Just let's wrap it up with your expansion plans. What's the view when it comes to international expansion as well?
So we, as I said, want to go deeper and deeper into India. We have 30 high throughput labs. We are expanding our lab footprint almost every day to go deeper into tier 2 and tier 3. And Africa remains a priority for us. Our first foot into Africa has been through Tanzania. We are watching that very carefully. A lot of management bandwidth is also going to ensure that that business scales up well, because once we have that foothold in Africa, I think Africa is a tremendous opportunity for us.
Have you on board. Thanks much for taking time out and joining in. That's the word coming in from the management of Thyrocare, talking about competitive intensity, which has lowered, but they are going to be investing across other regions. And as of now, the core business has seen healthy growth. 650, that's where the stock is currently at. All right.
If you like this video, then like, share and subscribe to ET Now.